Welcome back. You're watching The Money Show with me, Kavita Thapliyal. There are a plethora of funds available in the market to invest your hard-earned money, but how do you assess which is the right fund for your portfolio? What are the criteria and what should one look at before deciding a fund? To help you navigate through this maze, we have on board today Feroz Aziz, Deputy C1 and Rati Private Wealth. Also, do not forget to send us your portfolio queries on our WhatsApp number, which is 865-797-4571. You can also email us your queries on themoneyshow@etnow.tv. Good evening, Feroz, and welcome to the show. And first question I will be taking is of Sangita. Is Sangita there with me on the phone line? All right, I don't think we have, but then we are trying to get in touch with her. But she's sent her question. She's 28 years old and she already is investing in Parag Parikh Flexi Cap, PGI Mid Cap, and Axis Small Cap. She wants to diversify into a debt category also for liquidity specifically. If I have her on the phone line, we can ask her more questions. But then so far, what will be your suggestion? I think you're on mute. Feroz, you're on mute.
Good evening, Kavita.
Hi.
I think Sangita has done one right thing, which is to have three different schemes from three different categories. One is large cap heavy, that's Parag Parikh Flexi Cap. Then she has a mid cap scheme, which is PGIM, and then she has a small cap scheme. So the thought process in terms of the direction of allocating money across different market segments seems very correct. Second, I'm sure there is some degree of modification needed on the scheme selection. Coming on the debt side, if liquidity is paramount and this is not like long-term debt investing, then I would currently, in the current circumstance, prefer an arbitrage fund, which gives you a taxation of equity, but behaves like debt. I think in the current circumstance, the arbitrage funds are almost giving you 5.5–6%. Since the taxation is just about 15% on the short term, the post-tax returns supersede the liquid fund returns reasonably for a person in the highest tax brackets. That's what she should choose. In the arbitrage fund category, she can choose a Kotak arbitrage fund, which I think is one of the largest funds. And I think that should deliver about 5.5–6%, and post-tax, even for a couple of months of investment, she can get above 5%, which I think is very attractive.
All right. What will be the tax treatment on this debt category fund, Feroz?
The tax treatment is like equity. So if you redeem the money before 1 year, which is short-term capital gain, and that's 15%, and there's a marginal STT on it. So 15% taxation. But if you invest in a liquid fund, then it adds to your marginal tax rate straight away. If you're in the highest tax bracket, you might end up paying even 39%. But arbitrage funds can allow you to get a capital gain in the short-term capital gain head, which is at 15%.
All right, we move on and we have our next caller on the phone line, Captain R.R. Reddy. Good evening, Captain. Thank you so much for sending us your question. How are you doing today?
Fine.
I think you have a question on NPS, Tier 2 account?
Yeah, that is it, yes.
All right, and you want to know what will be the tax applied on this particular account?
Correct.
If you withdraw the money. All right. Thank you so much for sending us this question. And Feroz, before we get into the nitty-gritties on Tier 2 account, could you also explain and elaborate maybe on the two types of account, which is Tier 1 and Tier 2, that you get to invest in as per NPS?
Yes, so Tier 1 is the more lock-in kind of account where you do a compulsory or a compulsory lock-in till retirement, and at the retirement you have 2/3 of it which can be paid to you. 1/3 has to get into an annuity. That's a very restrictive step, because it also gives you the tax benefit under section 80CCD. So that's point one. Point two, Tier 2 capital is more flexible. It's more like buying and selling. You can do that with hardly any restrictions. So Tier 2 is going to give you a tax implication of just like an equity mutual fund, which is short-term capital gain at 15%, and the long-term capital gain will be taxed at 10%. And for that to bridge the gap of short-term and get into long-term, you will have to wait for 366 days.
Feroz, what I also want to understand is a Tier 1 account is a mandatory account. When you want to invest in an NPS, Tier 1 is something that automatically you get an option that you can start your investment with. Tier 2, is it important or mandatory or relevant to even have a Tier 2 account?
Yes, see, Tier 2 account is not mandatory, but it's a very relevant one because you get the same fund managers at 100 the cost. So if you're very cost sensitive, you can get most of the top fund managers in the country at a point 0.03 paisa expense. So that's point one. Point two is it can definitely give you the flexibility to buy and sell. One thing which is very important, Kavita, I should mention, is the gains you make from the debt component of the NPS. It's taxed as marginal tax rate and adds to your income straight away. So to answer your point question, yes, tier 2 is a very attractive one because you don't give away the liquidity. If you can, if you're not locked in, then your generosity with respect to your SIPs in that or your contributions could be significantly large because you're not hesitating. Because when you want to take a U-turn, you have the flexibility to do so.
So when we talk about having an active choice or an auto choice as per NPS, are all these features applied to a tier 2 account also, or you can just invest in whatever schemes you want to?
No, there is, you have to make a choice in terms of your fund manager. You can change that every year. And you can also change the allocation between equity and debt or at a frequency.
Okay, and the same rule applies for tier 2 also. Post 60, you get 60% of your corpus tax free, and then later on you need to buy an annuity of the rest 40%.
No, tier 2 you can withdraw your money at any point in time without this restriction.
All right, we move on, and we have Tony's question, and he's from Dubai. He says that current portfolio has SIP in Parag Parikh Flexi Cap, UTI Nifty Next 50, Quant Infra, PGM Small Cap. His time horizon is to invest for 15 to 30 years, and he wants to understand if the asset allocation is right for him, and he also wants to increase the SIP amount by around 10,000, and he wants to add a mid-cap fund, and for that he needs a recommendation.
So, Tony, firstly, when you do an asset allocation, the most important thing is they should be all assets. Quite a few people, without incorporating all what they have, other than the house they live in, is the only purpose of that is growth. If you have a holiday home, then you have a purpose of utility. That's not a part of your wealth. Wealth is every dime which you have, which you're not using or do not have any other purpose other than the growth of its value. So first, define every rupee you have. Even a hand loan needs to be counted. A PPF, EPF, your insurance policies, which are non-term policies, all of those, count them. And then you can actually arrive at an asset allocation. That's point one. Point two, your four schemes, I think two of them I would definitely ask you to consider an exit. Quant Infrastructure Fund. Quant is a good AMC, but infrastructure, why would you want to incorporate a theme into your portfolio in the beginning years of your investing? And I really think that fund managers, if they like a theme, anyways, in the diversified category, they skew. Like in 2008, this is what happened. In 2007, everybody was buying an infrastructure theme-based fund, and the funds managers of diversified equity funds were also skewing it towards infrastructure. So I've seen several portfolios which had 60-70% of their portfolio in infrastructure costs, in infrastructure stocks before the market crash, and that created huge amount of bloodbath. So let's not repeat that mistake and take thematic schemes when fund managers themselves can also skew it. So those are the two ones. I don't like index funds because I personally think 380 active funds, if you look at Kavita's shows and choose active funds a little more wisely, beating Nifty is not such an uphill task across 8 different categories if there are schemes available. Now let me read out some schemes to you which you can use for your new SIPs and the ones which you currently have and which you may so chose to stop. HDFC Flexi Cap, ICICI Pru Focused Equity, SBI Contra, SBI Large Cap, Franklin India Blue Chip, HDFC Small Cap. I think these are 6 schemes which you can definitely consider adding to your portfolio and make it a little more elaborate portfolio of 7-8 funds to make sure that your SIPs are reasonably diversified.
All right, we move on to our next question, which is from Kiran, and Kiran wishes to invest almost 10,000 from his savings to equity mutual fund for a time horizon of 10 years, and is looking at a combination of he wants to avoid the risk of volatility of mid and small cap companies, and which is why he finds it safer with the large cap category, Canara Bank blue chip equity, and is what is he looking at for his first investment. And he also wants to know one more large cap fund.
So, firstly, I think Kiran, the thought process of saying that small and mid caps are going to be very volatile and very risky is it's not so intimidating to buy this category if you're buying it through a mutual fund, because you have two layers of safety, and risk is something which I'll allude to with respect to the numbers which it throws up. Firstly, don't be so afraid of small and mid cap, because that's where the growth comes. If I look at the next 1 year's earnings growth, which we were just computing a couple of days back, small caps have an earning potential of 30% for the next year, and large caps have also 18 odd percent, and mid caps about 25%. So if you are a long term investor, small caps will not destroy value if you stay the course for long periods of time. And small cap itself has gone through an evolution itself, right? Last 5 years back, a small cap company, the biggest small cap company, was 8,000 crores market cap. Today, the biggest small cap company is 16,000 crore market cap. The name still remains small cap for the last 5 years, but the size has doubled. The number of companies which are greater than 3,000 crore market cap in the small cap category is 396. 5 years back, there were just about 225. So the universe has expanded. The size has expanded. They're still called small cap. If you numerically measure the value of the risk in the form of beta on a 3-year rolling basis, the betas are almost as much as Nifty is. On a daily realized standard deviation or the risk, it's a little more, but a 3-year holding period, the small caps risk converge with Nifty. That's a revelation itself from a mathematics standpoint. So I think if you want to, you're investing in an SIP, firstly, staggering it. If you're investing in a mutual fund, and then don't shy away from the most logical risk to take. So I will give you some small cap funds if you, in case you change your mind ever. So mid cap category, definitely. Let me give you Kotak Emerging Equities, the Pankaj Tibrewal scheme. You can look at on the small cap category, HDFC small cap, Chirag Setalwad, and Aditya Birla small cap. So these are some schemes which you can consider. And don't be so intimidated with the small cap risk, especially when you're investing in a mutual fund which has 70, 80 stocks, and you're investing in the form of a staggered fashion on a monthly basis.
All right, with that, we move on. Vishwas Kulkarni's question, Feroz, and he wants to know how is ICICI Pru S&P BSC Sensex Index Fund. He's looking at investing 12,000 per month for the purpose of retirement, and currently he's 31 years old.
If you're 31, Vishwas, to my mind, just buying a Sensex fund is not a great idea. See, like if you, of course, active funds can also underperform Sensex, nothing to say that. But if there are 380 funds, if you have a microscopic lens, identifying those 40-50% who are going to beat the Sensex is not such an uphill task. So that's point one. So don't put all your money in Sensex. That's not a prudent strategy. You will miss out on a lot of India growth story, which is represented in the form of small cap and mid cap stocks as well. So let me give you some active funds beyond what you have chosen for yourself, which is the Sensex fund, which is only 30 stocks. So HDFC Flexi Cap can give you a lot of exposure both on the large and mid and small cap space. You can add ICICI Focused Equity, which has only about 25, 26 stocks in the portfolio. SBI Contra, which gives you a contrarian approach. So you will have more schemes that will become complementary constituents rather than competing constituents to build a portfolio.
So Feroz, now I don't know if Vishwas is a new investor or a first-time investor, but then the fact that he wants to start investing with an index fund right now, you've given him the plan to later diversify, or maybe he should approach that first. Typically, for someone who is not aware of the market, is not well-read, an index is a safe play for them?
See, Kavita, I think mutual fund itself by design doesn't have its investors to be really well read. Because there's a fund manager, right? So if you're not well read, the other answer could be just go with an index fund, and every professional who's giving you the service of managing the portfolio can't be useless. So you have to find the people who are good. So to answer your pointed question, Kavita, even if you're a beginner, don't start with a small cap scheme, but there are actively managed great schemes. Like if you look at the Prashant Jain scheme, which Prashant left behind for Roshi Jain to manage in September 2021, has added immense value over the last 2 years. 14% alpha on Nifty. So how can somebody say that none of them can generate alpha? So having about 30, 40, 50% in a Sensex index fund is okay. 100% is not a great strategy, is the point being made for Vishwas. And I strongly believe that he'll be able to get a little more value than Sensex for sure, post the cost. Because cost is really minuscule. Now, if you look at the last 5 years, Kavita, you'd be shocked. The best equity scheme was Quant Small Cap with a compounded return of 38%. And the worst one compounded for the last 5 years was ABSL Pure Value, which was 4%. if the difference between the best and the worst is 34% compounded per annum, painting them all under the same brush may be a little unfair. So that's why even if he's a new investor, he can have some very well tested 25-year-old funds of prominent fund managers.
All right, with that, thank you so much, Feroz, for being on the show and helping our viewers with their financial portfolio today. And we move on. Now we know the government's decision to hike TCS on international rate card spends has raised a lot of questions in your mind. How will it impact you financially and how will you be taxed and so on? On the Money Show, we will answer all of these questions in exclusive discussion tomorrow. So do send us your queries on our WhatsApp number, which is 865-797-4571. You can also email us your questions on themoneyshow@etnow.tv. And with that, it's a wrap. Thank you so much for watching today. Goodbye.